Well, good afternoon, everybody, investors, and welcome. My name is Mark Robertson. Welcome to the May 31st, day after Memorial Day session of Bull Sessions. I am joined here by Ken Kavula, Len Douglas, and Matt Spielman. Good afternoon, Ken.
Good afternoon, Mark. Happy day after Memorial Day. Happy first day without the grandkids. Happy freedom again, right?
Well, we had 90 degrees yesterday briefly, so summer has arrived. How's the weather?
Go on, keep going, Mark. Yeah, I was just going to tell you how surprised I was that it's cooler today than it was. I was expecting a lot warmer today, but it's not turning out that way up here, at least.
Fair enough. Well, how's the weather on the south side of Detroit, Mr. Douglas?
Well, the Google Nest Hub says it's 83 outside.
Okay. And last but not least, how's the weather in Houston, Matt?
Well, we're practicing our walking for our big summer trip to Europe, and we wanted to get out before 10 so it would stay under 90.
Cool. Or hot, I should say. All right, we actually have we usually try to keep these fairly truncated on the day of a roundtable. We do have a roundtable webcast tonight at 8:30 Eastern time, but this one may or may not be truncated. We'll see how it goes. We have a bunch of things to talk about. Do want to talk a little bit about Warren Buffett and Apple. Want to continue our discussion on the electric vehicle and our hunt for opportunities. That will likely continue for the next couple of sessions. Matt can only join us today. He's going to miss the next several bull sessions, so we want to actually grab his thoughts as we close out here today, and he's going to share some thoughts on Borg Warner. And for those of you that are not aware, both Matt and Len both served in leadership capacities for automotive-related companies, and they've been active in investment education for the better part of 20 years, almost 30 years maybe, in your cases. So we welcome your involvement today, gentlemen.
Great to be here.
Yeah, likewise.
We will spend a couple minutes talking about the Dallas convention, which is about a little under a month out, and hence JR makes his appearance on the cover slide. And just a moment with my audacious moment of lunacy that, knock on wood, is actually going pretty well right now. Tequila Tuesdays. All right, so let's go ahead and get underway. Again, the standard disclaimer applies here. No investment recommendation is intended. This is about education. What it is specifically about is application of methods that have been developed and cultivated by the modern investment club movement for now nearly 8 decades. And so everything we do here is for illustration and demonstration of that type of stuff, how we think about things, how we analyze it, etc. So you're going to hear opinions from us. Every once in a while, we will own something that we're talking about. We try to remember to admit that. And again, the roundtable is tonight. So the May roundtable, and by the way, we were talking about the market doing a little bit better. We have actually outpaced the market with the roundtable tracking portfolio in a pretty healthy manner for the last couple of months. And we now have reached a degree of outperformance. Our relative return is over 6% again. So we'll cover that tonight. But it's kind of interesting to watch the relative performance of our selected investments for the roundtable actually outperform the market pretty resoundingly here fairly recently. If you'd like to be added to a reminder list for those monthly webcasts, the roundtables, send an email to nkavula1@comcast.net. And then if you'd like copies of the slides, or if you have follow-up questions, or even more importantly, suggestions for future topics, either here or at the roundtable, please feel free to send an email to markr@manifestinvesting.com. That's me, or Ken's email is kkavula1@comcast.net. All right, pressing on. Here's our quick look in on the market. We are coming a few weeks from now, we'll be locking in another green bar. Those are quarterly bars for the value line, the companies that form the value line arithmetic average. And the dip in the market has now crossed below the blue line. and the return forecast as measured by the value line median appreciation projection. Mark Holbert refers to it as VLMAP, VLMAP. That literally is the equivalent of basically a stack of value line based stock selection guides and the average return forecast. So you can see that it's jumped up into the realm where we should be able to find more opportunities to study and consider assuming ownership. Any comments or questions, Ken?
Well, Mark, I had a question earlier this week. Actually, it was before Memorial Day, from a listener that wanted to know when they deal with MAP, this value line medium appreciation potential, what happens to companies that have no earnings? Do those go into the arithmetic as zeros, or are earnings projected? Or is the stock appreciation projected even without earnings? Exactly what happens to that group of companies without earnings that are part of the value line 1700?
Yeah, and you would be talking about a handful, a relatively small handful of companies. Keep in mind that value line does use cash flow. Their preference is for cash flow over earnings, so companies will have cash flow before they'll have earnings. So that buffers some of that effect. But yeah, you're basically looking at price forecasts formed using cash flow. So you are going to have some companies that have negative earnings. Again, it's a minority, but they're in there. So it's literally looking at the aggregate price 3 to 5 years out.
Would I be right, Mark, in saying that value line is basically looking at those numbers that sit under the rankings, the high projected and low projected, and using some variation of that value in a list of how much the stock might make going forward?
Yeah, they're looking precisely at that, some type of an average forecast equally weighted over the 1,700 companies.
Okay, but they're looking at those percentage values that they're projecting up in the upper left-hand corner of the value line sheet then, right?
Yes.
Okay.
And of course, that we haven't said it, but that doesn't include dividends, so that's what makes it a little bit different from other forecasts which you might see. But for the last couple of decades, that has not been a material thing, the average dividend being a percent or less compared to the rest. So if that ever changes, we'll have to modify what we do. All right.
Okay.
We'll keep cranking along. Just a quick moment with the best small companies. We have been steadily gaining on the Wilshire 5000. A few more companies in green as far as the relative return, signifying market outperformance since last Halloween. A few companies continue to misbehave a little bit down there at the bottom. But again, we take the traditional, which is basically a buy and hold from Halloween to Halloween. That is going to be that red bar. Blue is we do permit some active portfolio management. We sold Green Tree, we sold eHealth and replaced them with Pachira and First Foundation. That's the difference between the blue and the red bars on the left. On the far right, that's just our reminder, and the bear is still there. The Russell 2000 Growth Index, the exchange traded fund, which tracks that index, is really challenged since Halloween for sure, and is solidly in a bear market since Halloween. And again, the small cap companies have been quite challenged. Anything jump off the page that you can?
Well, if this is like any other bear market, and I have no reason to believe that it's not, if it truly even is, when we look back on it, the small caps will be some of the first things to kind of wake up and move forward again. Isn't that what historically happens?
Yeah, and in fact, I'm going to skip to the next slide because that's a heck of a nice segue. Here is basically the outlook for those companies. As Ken was just saying, it's been in such a bearish situation. If you look at nothing other than the projected annual return column right down the middle here, some of those are perhaps even a bit frothy. And there's a lot of potential there. So yeah, I think it makes a lot of sense to shop and certainly be represented amongst the smaller companies. And
Yeah,
these,
I'm just gonna make one comment, Mark, about Merchants Bancorp, which I didn't discover until about 3 or 4 weeks ago. Merchants Bancorp very quietly had a small split going on in January, and if you're doing a lot of work and have maintained lists of these stocks since October and haven't split Merchants Bancorp, you might discover a few extra bucks in your portfolio, especially since they're imaginary portfolios in a lot of cases. It did split 3 for 2 back in January, and you'd of course want to readjust that because all of the data sources have readjusted their numbers.
yeah, I wonder if that is causing any disruption here. I'll double check that for sure. But yeah, there's some pretty good performers at the top of the list. Pretty good potential, I should say. The one thing that I think we might want to consider, Ken, that we had talked about, and we don't need to do it now, but I think we probably should do it over the next week or so. We had talked about the possibility of unloading Sharp's.
Mark, we lost you.
Oh my! Did I drop out?
You were fine for me, Mark.
We're losing you. Yeah, you're dropping out back and forth. You're dropping out. Yeah.
Okay.
Yeah, it's been fine for me the time. All
It's
time.
flying on gross sale.
Okay. I'll try not.
Then it's
Could
no,
be.
it's in Genesee then. Okay, go on.
I'll try not to move though. I try not to be too disruptive. The thing that we had talked about, Sharp's compliance, some of the expectations have been dialed back, and I think I'll probably write a piece about euphoria and how we kind of the principal and we being me, the royal me. Yeah, some of that euphoria that was generated by the COVID pandemic, and some of the companies and how they responded to it. The inverse of the chasm, if you will, or the chasm and the cannonball, all that stuff that we've talked about here lately. We may have been a little bit, and again, we being the royal me, overly optimistic with Sharp's compliance. And then I would throw Essent into the group. Nothing wrong with the company, but I'm not sure that a mortgage finance company is going to have a whole lot of positive outlook between now and the end of October. So maybe we consider a package deal and find an excellent replacement for the two of them. What are your thoughts?
Well, I happen to own Essent. We just went over it in our club that we own it in, and we decided, like we're doing with our homeowners, to weather the storm. Now that this is a different, we're looking for 1 year performance in what's going on here. So the conclusion might be, of course, separately, but we saw nothing fundamentally wrong with the company. And in fact, the earnings haven't been impacted to any great degree at this particular point. Now, of course, going forward, if mortgages fall completely or if they move to more cash deals and things like that, of course it'll impact the company. But for the moment, we're holding on to Essent.
Yeah, notice it is one of our top performers. So I'm the comments not directed at that at all, and it's precisely what you said, Ken. It's
Yeah.
will that particular industry be kind of stuck in the mud between now and October? No way to know. But yeah, you would think of it completely differently as a long-term investment. In fact, I might talk about Rocket Mortgage tonight. Completely different situation. I think Rocket Mortgage might be sluggish over the next several months, but the long-term perspective is probably superior. So you can be right on both ends, short-term versus long-term. And I think that's something we probably ought to think about as we attempt to have better performance between now and Halloween. All right. All right, just as a quick example of the sniffing around that we do, Ken does a lot of this type of stuff as he goes through his updates every week. And this actually comes from the Barron's small cap feature that is in there on a fairly regular basis. And I found myself kind of drawn to this Bentley Systems, which is described there. It's an engineering software for modeling systems, one of my favorite subjects. And those of you that are into virtual reality and that kind of AI type stuff, these guys are into that also. The three companies mentioned in this particular Barron's piece are not incredibly exciting, but I think if you take a quick look at Bentley, it's got a fairly short history, but pretty powerful expectations for the next couple of years also. It's a decent study and certainly one that you might want to have on your radar. Any familiarity with this company?
With none of those, but I'll add a fourth one, Mark, that we've had on the off and on radar in one of my clubs, and Josh Brown did a really nice 2 minutes on it this morning on television, and that's ChargePoint. ChargePoint deals with electrical charging stations for automobiles, but not from a gas station kind of situation, but rather from a fleet situation. So they would be placing stations in places where you would have large numbers of cars parked for long periods of times. So perhaps parking garages or Starbucks parking lots or places that wouldn't have a lot of in and out kind of movement going on, but would be able to charge a set number of cars over a 6 or 8 hour period during a working day, for example. And he really liked the company. It's been on our short list of companies that we really like in our Wolves Investment Club, but we've tended, again, to stay away from them for lack of any history in any of these companies. But he really did a nice 2 minutes on what the positives, at least, were in this company. I think it's CHPT, I think is the ticker for it.
CHPT? Okay, we'll check it out and certainly include that in the discussion probably next week, because Matt's going to basically come at this from a little bit different perspective here in a few minutes. Probably one you're going to like, Ken. All right, so then let's go ahead and talk Groundhog. Just a quick update. Herb Lemkuhl, you may have heard us talking with Herb in the green room, continues to be our individual leader, topped only by celebrity groundhogs, Huebner and Einhorn, who seem to do well in weird markets. Sean Mace moved back into fourth place. Warren Buffett, we're going to talk about here in a minute. George Mackey from Houston, hanging up there. But I think George has been right at the top of the list for a couple years running now. So good performance there. I also note that the North Texas Model Club has moved into the #1 position among groups. And the B.I. Baker Club, Ken.
Yep, we're sniffing around in the top 20 again, Mark. So
scratching at it. Keep
yep.
A lot of familiar names and a few special newcomers also on the list. Performance has improved a little bit. I would love to see this number over here get up closer to 40, at least 20, but 40 would be even better. Kathy Wood continues to struggle. So do I. All right. Thought we'd spend a moment talking about this one. I'd love to hear your perspective along as well as Matt and Len on this. That's a image of Warren Buffett. So apparently the news is out that Warren and Berkshire Hathaway are beating up on groundhogs. Doing pretty well over here the last couple of years, and that's an image straight from Insider Monkey, which we're going to show a little bit more of right here. And here's the question I have. Berkshire Hathaway is composed of 43% Apple in terms of percent of assets. Is that too much?
You're saying assets, that's equities.
Equities, that's true.
48 companies that they own.
Right, this is the equity portfolio. So
yeah.
It's not the, it would not include the railroad. What else would be in there, Len?
Oh, Lord, everything from precision cast parts to Pampers.
Homes.
Well, and insurance, of course, their bread and butter.
Yeah, Geico, General Re. Like I said, there's 48 wholly owned companies in addition to the $390 billion equity portfolio.
Mm-hmm. Yeah, so I'm focusing in on the equity portfolio.
Yeah,
I
okay.
understand. So
Said assets, that's what set me off.
well, I meant net assets in this particular portfolio. I apologize. And so this is their owned equity portfolio, and Apple is 43% of that. So let's just talk about that. I realize they're diversified into a whole bunch of other areas. So if this portfolio were yours, and we're talking about this trivial $363 billion portfolio, would that be too much Apple?
Well, Mark, I don't know if that's a fair question or not. Buffett and Berkshire in general has so many things that make it impossible to trade in a kind of sane way a lot of times. He knows that whatever he does moves markets. He knows whatever he does becomes public and alters people's lives a lot of times, especially alters their finances. And he can't be as nimble or as desirous of keeping a certain benchmark balance of any kind as the average person can. So if this were my portfolio and it were in the thousands of dollars or the hundreds of thousands of dollars, I would certainly say that that's too much Apple. But when you start dealing with a portfolio, what did you say, 345 billion, you said?
Oh, it's right here,
363 billion, 364 billion. I'm not sure that we can hold him accountable for not getting rid of, say, 10% of that holding or a quarter of that holding. In order to do that, he would probably destroy the price of Apple stock, don't you think?
It's an interesting consideration.
In the short term, at least, maybe not in the long term, but in the short term, at least. I mean, we have to remember that the stock market is a market, and when you put a whole bunch of supply on the market all at one time, that can really be disruptive.
And that's
the other thing I'd add to that, Ken, too, is what else is he going to buy, or why would he do it, right? So Berkshire, what I don't see in this portfolio is a cash position, right? And I'm trying to quick find what the most recent cash position is, but even as late as April, it was 140 billion in cash. Yep. So in terms of if he found something he wanted better than Apple, because he's slow to buy and slow to sell, he has plenty of cash earning zero to go put it into. So I would also say, as long as Apple is performing, that he doesn't have a reason to doubt their history and move away. The first thing he's going to do is spend or invest the cash that they have rather than need to raise money.
Yeah, and I think this is typical of either a club or in some personal portfolios where we'll find a portfolio dominated by an Apple or a Microsoft. Look at the round table.
Yeah, he should go to the repair shop. Because you look at the diversification pie chart on top too, right? That technology slice is the biggest slice. Well, that's Apple. It's not just an issue of, is Apple overrepresented in the portfolio, but the fact that we think we're good that we have technology exposure is a singular company too.
Yeah, and again, from the context of, if this were simply given to you, Len, would you work on trimming that position? If this $364 billion portfolio was handed to you, what would your perception of Apple be?
I don't know if I'd be spending any time at all managing it, Mark.
You'd have to start spending it before you had to pay all that inheritance.
The first question I would ask is, what was the acquisition cost? And I happen to know the answer. It's $34 a share.
So 34, and it's currently at approximately 150.
Yeah.
Yeah. So you're looking at capital gains for sure.
Yeah. Barron's estimates about a 45 billion of paper losses in the quarter in Berkshire's huge equity portfolio, which stood at 390 billion on March 31st.
Mm-hmm. Interesting. Well, I will tell you that.
You know, the one I don't see, and he owns 14% of it, is Occidental Petroleum.
I think that's number 6 on this list. You can drill into the entire list at Insider Monkey.
Mark, I'm getting comments from some of our listeners. Anat is indicating that when he goes to manifest, he sees a completely different list. Is that just because of the dates of the different lists that are available?
I'm not sure what list he or she is referring to.
Annette is
scoreboard.
He's going to a Groundhog Scoreboard 2022.
The public dashboard.
Yeah.
Oh yeah. Well, we don't actually break out the holdings of Berkshire Hathaway, but
Okay, so the answer for Annette would be that this is a subset of what you're seeing on the actual Groundhog scoreboard, then, right?
Yeah, on the Groundhog scoreboard. First of all, they're single point and day snapshots. This is the actual official standings. When I say official, every single price, every single dividend, every single stock split is accounted real time. So that's why this one can be slightly different. The dashboards which are on display in the forum at Manifest Investing were basically built back in February, and they will not reflect all of those updates. But and also the prices will be slightly different. And every once in a while, go ahead.
Let me ask a question, Mark, to maybe help clarify. Is the Berkshire scoreboard that's in 5th place in the Groundhog contest, is that the entire Berkshire Hathaway series of holdings? In other words, the stocks and the companies and the cash and everything, or is that just the stock's position in Berkshire Hathaway?
That is the total Berkshire Hathaway.
Okay, so that's a larger group of holdings than what we're looking at on the slide that you're discussing right now, then, right?
Yeah, that's what Len was getting at. This is a subset.
Okay.
Okay. All right. So, I mean, here's where that has stood over the last few months. And again, I'm asking the question, what should Warren do? And again, keep in mind, it's not just Warren, it's Berkshire Hathaway. And in fact, most of these transactions have probably been championed by his lieutenants anyhow, but he certainly is not complaining. But you can see in the equity portfolio, it's been nearly 50% of the portfolio. And I just raised the question just as things to think about. And if it were given to me, I would probably be covered calling and, opting out of some of the stuff. I don't know. And I tend to think of it as having a little bit of elevated risk just simply due to the age of Warren Buffett. If you're talking about an investment in Berkshire Hathaway, and now, don't get me wrong, love Buffett, love Berkshire Hathaway, but the reality is he is getting older. He refers to himself as Methuselah. And I do think that Apple has considerable Chinese exposure. We could talk about that in greater detail, but I actually lived through the loss of Jack Welch at General Electric. And I lobbied for reducing the size of our position in General Electric unsuccessfully. This is a couple decades ago now, and it's not quite the same situation. You definitely had a Jack Welch premium, and the premium's not quite as steep with Berkshire Hathaway, but who knows? So it's just a reality and just part of a risk consideration for something that's nearly 50% of an equity portfolio. That's my opinion. Thoughts?
It'd be interesting, Mark, to come up with the numbers that Apple represents as the percentage of the entire company. That shouldn't be too hard to generate, should it?
Well, I'm having a problem with the 50% because I believe you were quoting 47 billion. No.
This actual portfolio shows, call it 40% if you want. 40% of the equity portfolio is Apple. And that's what this slide is over time. It's just a time series of the same thing.
So I'm having a little trouble with that calculation because I think it's like 155 billion over 390 billion.
Yeah, that's what I say. You call it 40% plus or minus whatever, it's still a large number. In terms of traditional portfolio management guidelines,
More like 39%.
Mm-hmm. All right.
Yeah. One comment before you leave. Since I happen to own Berkshire Hathaway, among other things, I'm more comfortable having my Apple position being part of Berkshire Hathaway than owning Apple by itself.
Okay.
The other thing, the thought that occurs to me in terms of putting that in context, Berkshire certainly is famous historically for having a number of large positions they kept for a long time. So I wonder, at what point when American Express, let's say, peaked or they finished buying it, what was their percentage portfolio then? Or of course, there's Wells Fargo, which they moved down on, and then Coca-Cola. I wonder. Is it to say, okay, so for the average investor, that's very unusual, but for Berkshire, is that unusual? Sort of as they're buying or as they're accumulating, is that quite a bit higher than prior peaks?
Yeah, I think it is significantly higher, but I cannot put numbers to it, off the top of my head. All right, well, let's go ahead and press on. Some of those things we will be talking about, continuing to talk about, but we have spent the last couple of weeks talking electric vehicles, pointing out that the first electric cars date back to nearly the Civil War, and that Waverly was actually from the 1890s, and I think you guys checked in with a range of 30 miles or so for a total range on that vehicle, something like that, and a hair-raising speed of how much?
I think it was 16 miles an hour.
16 miles an hour. Good stuff back then, I'm sure. But again, we want to spend the next few weeks just searching for opportunities. I think we have experienced some fairly decent feedback with Littelfuse as one of the companies that may prosper across the board, and we'll continue to search for that type of company. And Matt provided this slide last week. I left it in there just to show the broad span of this topic. How would you characterize this, Matt, in a nutshell?
Yeah, automotive has a big impact as is, or as an internal combustion engine. So messing with it, looking to disrupt it, looking to move a basic component of it will have broad impacts. And so one, the opportunity is probably pretty big, but two, it's probably commensurately, proportionally difficult to predict exactly what it'll be. And that's the other point I like about this. It's a busy slide, and the numbers can be small unless you have a nice, decent screen, but these are not all positives, right? In terms of the viewpoint of each of these sectors, public sector, media, whatever, there are pluses and minuses. And so working out where to go can be that much difficult, not only as an investor trying to pick winners, so to speak, but also in terms of a public policymaker trying to decide on laws to encourage this disruption or protect your home industries, those sort of things, or even as a consumer looking, what is your next car going to be? Internal combustion, electric, hybrid, that sort of thing. So don't feel bad if it's confusing or it sounds difficult, even if you're only involved in it kind of tangentially. It's a big deal. It'll be a big deal, and it'll take a long time to sort out.
Now, my big takeaway from this slide, Mark, was that we have to stop thinking, and we have to get our news people, our talking heads, the people that send us ideas and information, we have to get them to stop thinking in a linear direction. It's not a simple case of A does B, B does C, and C does D. It's ripples, as you talked about, a ripple tank, and they're going in all directions, and they're going in those many different directions simultaneously, and they're disrupting all kinds of different things that most of the analysts that try to sell us a particular message or a particular way of thinking haven't brought into the conversation at all. It's the idea that there's so many things that touch this, rather than just a nice simple progression of move to electrical vehicles and you begin to solve all kinds of problems immediately in a straight line.
Yeah, and one of the things I'd like to get into perhaps next week, if we get a chance, Ken, is your clubs have been studying this topic, and I'd love to hear, what type of general direction they're seeing. But let's table that for next week and turn that loose on, and we'll come back to this also. That just simply demonstrates the intense cyclicality. This is a subject that Len has studied in great detail, so we'll come back to this one also. Just the reminder that it is quite a turbulent landscape when it comes to energy and transportation. So we'll come back to that. And we'll spend some time with this in the future too, just simply talking about the realities of the economics in terms of the mileage and gas versus electricity. And then I like this one, Ken, because I don't know if you caught the articles, but apparently Michigan is in crosshairs for challenging our grid and probable blackouts. So I think I may be looking into a Ford F-150 Lightning. Maybe. Did I lose you guys?
No, you didn't. That's an interesting fact. I realized that you could use the car to help your house's power. I didn't realize it could be done for up to 3 days in a pinch. I wonder how much power that's actually providing in a 3-day period.
Well, Matt and Leonard are mapping that out for us in the forum. So
great.
Well, I can give you one data point, Ken. A Tesla 3 standard has a 62 kilowatt hour battery.
And that's what, 2 or 3 times normal?
Well, my C-Max has got I think a 7.5.
Wow.
Yeah, a hybrid is going to be much smaller, obviously, and a lot of that is just area in the car devoted to it. But you can compare. I mean, you can compare batteries to a full electric car, and I'm sure the Lightning is probably bigger than that because it has more power, particularly to tow. And just compare that to your electric bill and how much you use in a month. Find the days.
So it's basically a simple division, Matt.
Yeah, I mean, it can be. There's more hardware. We had talked earlier. I mean, if you're going to draw air conditioning or even your refrigerator maybe, but some high draw appliances may have problems. May pop a circuit breaker coming out of the truck going out. But there are home solutions you can connect that to, so it's still the car providing the power, but sort of evened out. But yeah, I mean, its potential is for a lot of the house.
Okay.
I've been assured that I can run my laptop off of it sitting in my driveway.
I need to run the pump for the water, Mark, is what I need to run. So.
Oh, there you go.
Another important thing.
All right. So I thought what we would do in the vein of searching for stocks to study in this realm of electricity versus gas or both, Matt volunteered to cover Borg Warner. So go ahead, Matt.
Sure. Coming out of last week's discussion, and Mark alluded to between listener feedback and our own email conversation, last week's discussion said something's happening and it's big, but it's not really our thing. Something's going to happen, and who knows who's the winner. So what are you going to do? So that sort of got me thinking along these lines, and this is more of let's say a linear play, but less of an all-in sort of play into what's going on. Let's go to the next slide. So I'm going to start with just a little bit more orientation because there's a lot more obviously you can dive into this a lot more deeply technically, but one clarification. So when we talk about electric motor, a lot of people have in mind an industrial electric motor, so something up like in the upper left. And an automotive electric motor has principles that are that simple, but is a lot more complex. You can see here a disassembled Tesla Model S in the upper right. And there's an excellent video with the link on the bottom that has an exploded view of the Audi e-tron, which is one of, let's say, the newest generation motors. But so this is not just bound wires that are spinning, but they of course have differentials, right? So the motor turns at a different rate than the wheels turn on the ground, of course. But particularly in the case of trucks, they actually have transmissions too. You have gears, in particular because you want to tow. It's one of the things I had to agree not to have when I got my Pacifica hybrid. Not that a Pacifica is a big towing beast, but there's no towing capability. And a lot of that is because of the load that any kind of even moderate towing feature will put on an electric motor specifically. So there's a lot of knowledge that traditional automakers have already that are still applicable to this. It isn't entirely throwaway, even though, of course, and again, that's the whole motor in the upper right. There's obviously a lot of space versus an internal combustion engine. Next page. So one of the ways to explain this, and I did post this to the forum before, so these are a little small, but you can see these are all electric cars. Some are hybrid, some are fully electric, but they are not all the same. And it goes top to bottom, and the Porsche Taycan is listed twice, so you can see where the brake is. But you see some traditional gas cars beginning with, but even hybrids, even Toyota and Lexus, you see that there are actually not that good for let's say MPGE, miles per gallon equivalent. You start to see some of the big trucks, and again, the trucks have a specific compromise they have to make because you want them to tow, and so they are not optimized for fuel efficiency necessarily, even though they're a lot better. It's a lot better to get electric over their gas cousins. And perhaps not surprisingly, at the bottom right all the way down, although the Chevy Bolt is close to them, Tesla models coming in. Now only the Y and 3 are put in there, but you can see that they are multiples of even other vehicles there. And honorable mention to the other picture on the right, the Nissan Leaf, one of the oldest electric vehicles around, still one of the best gas mileage there. And part of that is driven by its size, but for the technology that went in, as long as it's been in, very good performance. So just
Matt,
we'll get into motors, but just a little.
Could I just ask you to clarify the graphic real quickly? Is the 125 next to the Tesla Model Y, is that the miles per something equivalent number? Right. Is that what we're talking about?
Exactly.
Okay.
MPGE. It's the label. The label is right above the Toyota Corolla there. MPGE is what you use when you talk about electric vehicles. So yes, miles per gallon equivalent.
Okay, it's an equivalent number. All right.
Right. Yeah, because it's a fully electric vehicle, so you have to turn your energy use in whatever way into some equivalent form.
And one more clarifier. Any idea what the variance is on these numbers? Is it plus or minus 10%, plus or minus 5%? How accurate are the values themselves? Do we know?
Well, yeah. So now I'll say I don't know if I'm looking at the source. I don't know if these are officially the government numbers. So the government has a specified, and it's not really a route. You run it on a dynamometer, so you spin the wheels while you're in place.
Right.
But yeah, I mean, obviously your driver will vary as more than your car will vary, and if you're an aggressive driver or drive a lot of hills, you're going to have a different amount. So these are standard. I would have to expect these are the standardized numbers you would see on the window sticker. Kind of paradoxically, a lot of electric vehicles actually get better miles per gallon in the city than in the highway because they have regenerative braking and actually recharge as they slow down. So it's not a full waste when they brake.
Another dimension to the matrix.
Yeah. So like I said at the top, so something's going on. What do we as not just investors, but better investing style investors do? And really, a lot of the names we throw around, and Ken, you mentioned ChargePoint too, really seem more like speculation or almost a casino, right? Looks good, the product's good, they talk a good game, it seems good, and then, you know, whatever you bet on throws out a going concern notice, right? And Lordstown had one actually since last June. They're going a year beyond it. But it gets more concerned because, of course, cheap money isn't around either, right? Whether in terms of a high stock price that you can issue more stock on reliably, or getting a loan is both tougher to get and you have to pay more. So one news item could be great for you, or one news item could be terrible for you. And then at the bottom is the one-year chart for Tesla. It's actually up 35% over a year ago, but I'm sure there are plenty of Tesla investors, if you invested after, let's say, October or so, that are down just as much. So how in the world, you want to be involved in this, you don't want to sit on the sidelines, you don't want to wait for the winter to come in and then get your 10% or even 15% market amount. How do you get in on this? So that's what I was looking for when this idea came to me. Next slide. So Borg Warner. Borg Warner is a tier 1 automotive supplier, so they work directly with the original equipment manufacturers, the OEMs, the car makers. Their expertise is around the engine and transmission, so under the hood, and that's why I subtitle this. They have the most to lose, in the sense of, if you take the hyperbole that the internal combustion engine is going away. But again, there's a lot of knowledge that they have that actually is applicable in both cases. Probably the supplier that's closest to them in this would be Robert Bosch out of Germany, but unfortunately you can't make a lot of comparisons to that, since they're not public. They're owned by a charity, actually. So they're really probably deepest directly in not necessarily just autonomous vehicles. There are a lot of tier 1 suppliers working on the software and systems for autonomy, but the electrification of cars. Next slide. So Borg Warner started as Warner Gear in Muncie, Indiana. All sorts of auto suppliers have hometowns, mid-sized cities in Indiana. And this first slide is sort of their traditional product line. Lots of things on fuel systems, fuel injection. Of course, they started as Warner Gear, so transmissions, pollution control, turbochargers, lots of things around that stuff that Tesla says we don't need anymore. Next page. So what they've been working on is sort of the same area of the guts, but what does that mean for an electric vehicle? So you can, in the bottom left, are actual electric motors, so the actual thing providing the torque. Next is electric drive modules, so around the motor, how do you connect that to the car? In the upper right is a transmission, right? So this is much simpler than your 6 or 8 or 9 speed transmission, which a modern car would have now. It may only be 2, even for a truck, but it's something you know to do, and it's something that helps the performance of the car. Notice, talking about charge point, in the kind of the near left upper is actually chargers. That's a full size standing charger station. Is something applicable too. And then a lot of things like power electronics and thermal management were applicable in both cases, but it's something they've been working on. Next slide. Just to give kind of an overview, what does it mean to be an electric car? This is sort of your generic electric car. I will say, notice that the front seats in this car are facing back, so it must be an autonomous car. No one's paying attention to what's going on. That's what can happen in the interior of a car. But sort of, what would all the pieces be? And you can see kind of in the middle underneath the seats, that's the battery. The battery is literally half the surface area of the car, or let's say half the square footage of the car if you look at it in a top-down view. But there are a lot of things around the wheels and in back where you kind of have the motor and the transmission together, so it's rear-wheel drive. Those are sort of the things they do, and Borg Warner is making the point here that they're putting in place to sort of cover this whole new propulsion system, just like they do and had covered gasoline propulsion. Next slide. So they're not developing this from scratch. They've been very savvy serial acquirers in this point. And I can remember back, so Remy International, I have experience with them, was one of the first spin-offs from Delphi prior to its bankruptcy in 2005. They were a one-trick pony based out of Anderson, Indiana, that made starters. And if you think about electric motors now, you think their junior cousins, maybe their ancestors or grandparents, are starter motors. And starters grew to the point, if again, a lot of electric cars now, and really for almost 20 years in Europe, you'll have stop start, where the car will stop at the stoplight, and your engine will start up in the point that you push the gas pedal, which is disconcerting the first few times if you're used to kind of turning the key and letting it turn over for a few seconds. But they grew up, and Remy, owned by private equity at the point, really parlayed their one trick into a second trick, which is growing them up a pretty strong patent portfolio around the kind of energy that a car would need to move on an ongoing basis. But that's one example. You can see a number of these, and to the right shows what that impact is. So their organic portfolio, what they made is the bottom two bars there, right? So of their expected revenue per car, per electric car in 2025, only about 20% of that, 1/5 of that, is things that were Borg Warners before they started on this path. You can see here Remy is as big a portion in itself, because that's actually motors. And go back and think and look up and see how much they paid for Remy, and look at the annual revenue they're getting from that. You can see how good a move that was. And then everything else on top of that. And this will be something that they continue to do explicitly, and that'll be further on. By the way, these slides starting now are from their Q2 2022 investor update. So you can go back and see their whole pitch for this. That's most of what my presentation going on is pulled from.
Matt, was Remy tied to Delco at some point?
Yeah. As a division of GM and Delphi, that was Delco Remy, and then when they were sold off, they became Remy International, but their products still list as Delco Remy.
Okay.
So not only is there a lot of additional content that they bought for electrical vehicles, but that actually compares very favorably to their combustion content now too. So you can see as the fleet, the built fleet of OEMs moves from pure combustion to hybrid and then to electric, they're expecting not only to be able to grow with that, but grow for each car that comes on to have a better opportunity going in. And that's why they're changing their portfolio. Next slide. Looking at the expected growth. So this is the point where we can talk about what the hyperbole is and what they do. And it's one thing that a lot of people outside the automotive industry aren't very familiar with. So I'm on a few discussion boards for Luminar, a LiDAR maker that I'm involved with that's not directly dealing with electrification, but certainly with autonomy. And people are dismayed when they announce that they have a 2024 program sale and wonder why it isn't tomorrow. And my response to them is, in the automotive world, 2024 is tomorrow, in the sense that once you have a product you like, being able to make that in a mass amount to the expected quality standards you can, so not to have issues, but also then to meet all the safety requirements around the world, takes that long. So we look at 2025 being greater than 25% electric vehicles. That's a significant move, even from today. And then 2030, 45% is essentially one generation or generation and a half after that. Now, what makes this more believable than just hype is there are a number of jurisdictions in Europe, for example, that have mandated that all new vehicle sales will be electric, right? So you have some countries in the world that are pushing this from a policy standpoint. You also have General Motors has committed that it will be all electric by 2030. So they have obviously profit motive beyond that. But there are a number of public statements from, and put General Motors aside, from people who don't have to answer to the market that are pushing this adoption. Now, could they change? Of course they could change. But right now, that's sort of the marker people are working to. And you can see on the left, what Borg Warner is calling their charging forward strategy is 3 areas they're working on to make sure they're prepared for that growth. Next slide. So now this is Borg Warner's internal numbers, and so they're looking at from 2021 being less than 3% of revenue to be electric vehicles to sort of matching that 2030 view where 45% of the revenue, just like 45% of the market, would be EV. So they're looking to match that and drive a number of changes to their own portfolio. Now, I give them a lot of credit to this, and I have a lot of friends that work in Borg Warner. No less because they've bought a number of former Delphi divisions. I give them a lot of credit as an incumbent not to try and milk their existing business, just either write it into the sunset or fully forget about it and look in electrical vehicles. They still have actually a pretty healthy number of patents that are being issued for their fossil fuel technologies, in addition to the electrical investments they're making. So while this presentation has a lot of words on electrical, it isn't to say they're abandoning their fuel vehicles. And you can see it's not 75% or 90% of revenue. It's as close as you can say to 50-50. Next slide. So another point about the automotive industry today is most OEMs own and develop internally their own engine and transmission systems, right? That's a key system, a key point where you can differentiate yourself and not something you want to farm out. However, there are a lot of components, a lot of either because they're patented IP or areas where an OEM may feel they're behind, where they do go out to suppliers. So you end up, you rarely see whole engines that come out. I mean, Cummins might be one in the heavy duty, which is known for doing the whole thing. And some transmissions too, but a lot of OEMs do have expertise in this area. So it's not going to be 100% sent out to suppliers. So I think this is also a point of view where they're very realistic. You can see the gearbox, right? So not only do OEMs do transmissions today, they do much more complex transmissions than what electric vehicles require, but they still have not only engineering expertise, but plants with unionized workers that are making these products. And so you can see that the balance of OEM in-house development here is heavier than other components, both because there's existing knowledge, but also because there are existing infrastructure. We might say there's a brownfield for the OEMs to try and not only keep their own value add, but also occupy their business, to say. So this is just a point being, it's not a uniform thing. It's not all or nothing. It's an area that tier one suppliers are used to working in, that they will help an OEM even if they declare that they have their own solutions. Still will be with the involvement of suppliers. Next slide. So this is going back to talking about capital, and you can see there's a significant amount of cash flow here. I won't say free cash flow, it could be, but you look at, and this is not annually, but for the next 5 years, about $7 million. You can see they're maintaining their dividend. They are doing some share repurchases, but a large total of this. Now this is going forward. This is not any of the acquisitions they made so far. They expect to continue to make acquisitions to build out their portfolio. Again, in my own judgment, I think they've done that in a very smart way so far. I hope and expect they can also do it in a smart way when you're in the market, like you're in any market. If there are multiple buyers, it could be that there isn't anything available at the prices they want. But you can see there's significant capital they're willing to deploy to meet this sort of 50-50 balance.
Matt, interesting choice of vocabulary. Dispositions, is that a synonym for selling off part of the company?
Yeah. They have done, and in particular, there's a number of acquisitions they've done, which then they have then divested certain pieces of it, like aftermarket pieces or something. So yeah, exactly that. So this is a partial SSG, and you do see this is an automotive company, so it's not quite up straight and parallel, although the revenue line is quite nice. I am heartened looking at the investment audience they have. You look at 2016, and I don't know exactly what it was. It's some kind of a profit hit. The revenue didn't go down, so it was some kind of write-off or profit statement, and that did not tank the stock that year. Their revenues are up last year and still looking to continue to go up. Profit is down. Of course, there are tremendous amounts of supply chain pressure.
Matt, when does their fiscal year end, Matt? What is it, June or is it December?
No, it's calendar year. Yep.
Calendar year. So I was going to guess that was taxes, but it wasn't. Okay.
No, yeah, it's a little early for that. Yeah.
Yep.
Yeah, that was my first guess too, but it's not. Looking at a very healthy sales growth of 10%, and then of course an expectation. Of course, people just expect normal. But if profit can normalize to that revenue expectation, very healthy revenue growth, and then out in 26, the value line expectations in line with the next 2-year analyst expectations as well. Next slide. So looking at the back slide of the SSG, there are a couple things here. I just mentioned that 2016 big profit hit, and 2017 was sort of recovering from that, or also depressed. As you covered, Ken, in the last ticker talk, right? That's not only a high number, that's also the oldest number. It's pretty easy to strike out. My own idea would be that 2021, again being crazy pandemic year, would also be something to strike out. I'm even more nervous about 2020. Again, a lot of things, as long as you had earnings, could set high prices in 2020 as well. But then we've struck out almost half the data. But let's say an average PE ratio still in the low teens or low double digits, high in the, let's say, mid-teens, which is about where it is, even though it's nearer its 52-week low than high. Next slide. So manifest, high quality, 88 quality, nice par. I'll say this is with a lower expected sales growth forecast, but the average PE of 15 versus what I had 11 around there before too. So let's just say my SSG shows pretty similar, and you can have some leeway to pick what you think those numbers are anyway. Next page. Looking at our references, now this is pretty old from Value Line from March, so it'll be updated in just a couple weeks. But the price is about the same. The price I think is about 39 and change today. So nice low price appreciation from Value Line, 5 stars from Morningstar. Next slide. So, and really this is the other point, right? So all these other investments are great as long as electric lives up to its hype. And it doesn't even have to be, well, electric goes away and gas comes back. What if it's delayed 5 years? What if there's a legal challenge and sales are somehow blocked in a significant jurisdiction, or there's a risk of liability in some way? Given, and I put sort of the smaller pieces closer to the explosion, right? Those could be existential questions for Canoe, for Rivian, for Lordstown, for Fisker. Tesla is an established company that should end this year with a production capacity of 2 million cars. So I'd even say they're a major automaker, not just because of the noise they make, but the numbers they make. Waymo, of course, has their parent company Alphabet to get them through issues. But it may be a point of surviving a rough patch more than necessarily better or worse. One more click. But I look at Borg Warner and I look that they have nice prospects and that they will be able to profit from this coming stream. Again, no matter which OEM wins, quote unquote wins, because certainly no one is going to have 100% of this market. And to whatever degree the electric transition is slower than expected, they are, I'll say, perfectly happy. Of course, they're making a lot of investments in electric, so that wouldn't make them happy, but they are perfectly able to supply current technologies as well. So I think this is a good opportunity that actually is a significant hedge against whatever unknowns come from that complicated chart of all the things that electrification is impacting.
Cool. Thanks, Matt.
We do have a few questions. You want to take them after the recording since we're past?
I think we're all right. We will warn people we might go a little bit long.
Okay.
I can table stuff for next week for the Dallas stuff. It'll be in the slide handouts. But Ken, did you have any questions?
I don't have questions, but we have some from the audience. Nick would like to know, in your opinion, Matt, when do you think that an electric car would reach a distance, a charging distance of 500 miles? Nick happens to feel that 500 is kind of the place that a lot of people would seriously consider buying an electric car at that point then.
Sure. Well, actually, I mean, the 250, let's say 300 miles, the 300-mile range that's given wasn't a guess. That is a target over typical travel ranges that are done for the whole population. So there is a large amount of the population that it covers. I also don't doubt that longer ranges would be useful. I mean, the RV industry, for example, and of course the RV has more space for batteries, but that still adds up. We're putting more on, but not surprisingly, they want much longer range. Right now, I think the emphasis is more on looking at, I don't know, you might call it density, at faster charging times, right? So people are more dissatisfied with having to take 2 hours to charge the battery, even though that's a lot faster than what it used to be, than worried about 300 versus 500 miles. They would like to get a battery that charges in 15 minutes. I'll simply say from a chemistry standpoint, there are a lot of alternatives for batteries coming. Some of that is going to depend on the availability of rare earth elements, but I do think that's a possibility. The other thing you could think of is that might be for more specialized vehicles. Again, would that herald the return of the full-size van? Because again, just because you have the battery space, or might you compromise on storage space, maybe as an option, right? You can have the big trunk in 300 miles, or you can have the standard trunk in 500 miles, something like that. Is it possible? It's entirely possible. I think it's more about, as it's a developing technology, what is the largest customer base clamoring the most for, or the loudest?
Okay, Nick, I'm going to suggest you take some of these questions, and Nick has a series of questions, and you take them to the Manifest Forum. Matt is pretty active on that forum, but he can maybe enter into a discussion on some of these questions that you have. I think that other than that, we don't have a lot of other questions here, except one of our audience members questioning how many folks would be comfortable charging a car in the rain. I think it's something maybe you just get used to doing, but I might be way out in left field. Matt, do you have an opinion on that?
Yeah, well, I have a hybrid. I have charged it in the rain. I mean, the connector that's used, if you look at a type 2 connector, and even if you plug it into the wall, and hopefully you wouldn't be plugging your 110 into the outside wall charging in the rain, but if you look at a type 2 connector where you plug it into the car, it is an automotive connector in the sense that all of the conductors are shielded by plastic individually and isolated. So I don't know firsthand what sort of environmental testing there's done on the charging systems, but I would expect in the rain is definitely an expected condition. And again, either you do that or you just do it indoors. But I mean, there are a lot of considerations around that for safety too. An electric vehicle comes with essentially another airbag, so your airbag is an explosive, and hopefully it doesn't have shrapnel, right? It's the explosion actually captures the gas to inflate the airbag. There's another one in an electric vehicle that actually disconnects that battery on purpose in an accident so that it's safe for emergency crews to approach the vehicle, so that the frame is not electrified.
Okay.
So there are a lot of safety sort of scenarios that are definitely considered when you have this much energy stored in the car. Now, you have that much energy stored in the gas tank too. Remember the Datelite NBC controversy with the Chevy side saddles and the exploding gas tanks that were outside the frame, right? I mean, gas tanks aren't necessarily safe. They're just what you're used to.
Right.
They're not unsafe, but it's the devil.
Well, we go all the way back to unsafe at any speed in the Corvair when we're thinking about those kind of things. Mark, I would suggest that maybe we solicit our audience and ask them for the names of companies that we think have a have a chance to move in this Borg Warner mold, which is to leverage existing technology that they deal with and to keep that technology moving while at the same time moving into some of this new electrification kind of thing. I'll put one company on the list that we're studying right now, and that's BP. It sounds kind of strange, but we're looking seriously at British Petroleum.
Sure.
Because they've made some statements about how they are not going to be able to be a traditional energy company in 30 years, you know.
Yeah, and
So,
absolutely. I mean, even companies like Gentex are doing things in the area. So
right,
I think the thing we'll pursue next week, if not next week, the week after, is to basically grab an ETF and go right down the laundry list of companies to see what we might find. And so that's on the agenda.
Matt Joe is curious, what kind of EV do you own?
I own a Chrysler Pacifica hybrid. I owned it. I bought it last April, which is the beginning of all this. You can't find. Actually, that was funny. The Wall Street Journal just had an article that said minivans are it now. Try and find one. So the plant up in Ontario was already shut down. So I ended up having to fly to Lima, Ohio, to pick mine up and drove it back, which is a luxury of having been relatively recently retired, to have the flexibility to do.
Well, I can tell you that we actually work for Chrysler / Stellantis, and our replacement vehicle is the same thing you're driving, Matt, and it's taking months to get it even to a company employee. So
my hybrid is Siemens Energy that I've owned since 2017.
Yep.
That catches us up to date then, Matt, Mark, and we can say goodbye and get ready to reestablish contact this evening with our folks, okay?
Yeah, what I'm going to do is go ahead and leave the slides in the handout. People can take a look. I would encourage you to take a look at this one because Ken and I have been working fairly extensively on par versus prove. And that's a fun slide. Scratch your head over it. We'll talk about it next week. And that other slide, which you've seen in the past. And you can take a look at my tequila slide, and we'll also talk about that next week. So these will stay in the deck, and we'll pick up where we left off. So with that, we will get together here in a few hours. And thanks, everybody. Thank you very much, Matt. Good luck on your hiatus here for a while, and we'll look.
Safe traveling, Matt, okay?
I did ask Matt to join us tonight because we want to throw Borg Warner onto the roundtable pile also. So he'll give an executive summary.
Mark, could you stick around? I want to show you 2 slides and ask you a question, okay?
Okay. I'm going to go ahead and shut down the recording. Thanks, everybody.
Yep.
Take care.